Switching back to page one, Tesla at the right price, it seems to me, is a large company. It could have that kind of step change potential, not necessarily from cars, but from autonomous driving.
Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Exhibit C first. I think this column for 2025 will last maybe one more week. But a couple things have happened since last Wednesday. There's all the publicity on the possibility of the U.S. lifting sanctions on Russia. There's the news that the Russians have volunteered to intercede between the Iranians and the U.S. on the U.S. lifting sanctions on Iran. And OPEC Plus has decided to go forward with their increase in production April 1. They divided it into, I think, 14 months or something. So it's about 130 or 40,000 barrels a day per month increase was designed to get them back those 2.1 million barrels they curtailed. As you can see on the bottom of pay or the demand, the liquid fuels consumption table, this has consumption up 1 million barrels a day from 24 to 25, with China flat, US up slightly, Europe actually down a little. Even other Asia, which has been very strong, up just slightly. And so it's kind of a weak picture for demand. So we need to have supply stay flat. And in fact, this 25 column stays flat, but it has Russia curtailed by 600,000 barrels, has Iran curtailed by 800,000 barrels. If those things go by the board, there will be lower oil prices. But all these things are kind of speculative. Iran says they have no interest in dealing with the U.S. Russia sanctions depend on having a ceasefire with Ukraine. That still seems a while off. So we'll probably hold to this column for another week, but it definitely should change back to being where there's 1 million barrels of surplus. They go back to 3.5 or 4, and that'll be much lower oil prices. On Exhibit B, the cold weather's done its job, but the problem is dry gas production at 105.5. We're already there. Next time we update it, that'll probably go up a little. I think LNG feed gas will also go up a little, so they may offset. So the futures price is $4 for 25, $4 for 26. Those are substantial improvements from 240 for 24. But let's hope they hold. This estimate is for 350, down from a $4 futures. I think that's a more realistic number. U.S. government revenues and expenses, to talk in the president's address last night about waste and fraud, but not too much on actual reductions in spending. By March 12th, there has to be a continuing resolution. Otherwise, the government starts to be unable to pay its bills. That may require some Democrat votes in the House. I don't think they're there if you take them at their word. Trying to get all the Republican House members to vote for continuing resolution will be a daunting task, but that's what President Trump and Speaker Johnson will have to do. Mike, Jason, anything else to add?
Nothing good to say.
Yeah.
I thought the whole event was a little unprofessional all around, but yeah,
Right.
That's where we're at.
Yeah. I'd like to focus in the three of us on step changes. That's what we wound up talking about last week. what do we mean by a step change? What we mean by a step change, if we turn to page 3, is what Nvidia was able to do. I mean, Nvidia's revenues, when they were just a chip, GPUs for gaming, I'd have to go back and look, but I think their revenues were under $10 billion a year, maybe considerably under. And on a current run rate, they're $130 billion. Finding another one like that will be a daunting task. But that's, I think, what all investors should be trying to do in this market, because macro looks pretty uncertain. We might even have a recession this year if there was enough uncertainty on consumer spending and investment spending from tariffs and, trying to constrain federal spending. And the capital markets are liable to be pretty volatile. So if you can find something that, as I say, a step change, something that doubles or triples in a few years, that's what's to look for. With Nvidia, it's happened. I think Nvidia now is, pretty mature. I mean, golly, look at page 3. It's it's a $3 trillion valuation. So it's $3 trillion going to go to 6 or 7. I think that's unlikely. And I'm not sure that I see on the chips page any potential for doing that. I guess if Intel somehow turned around, you might have that kind of potential, but that seems very unlikely. Mike, Jason, anything else in the chips area that be a potential step change?
I'd say with Nvidia, I mean, you're right. If you go back to when Jason and I first started investing in this, when nobody was really talking about using GPUs for anything other than gaming, they were doing maybe $6 billion a year in revenue. So, they've come a long way since then. And I think what we learned from investing in that company is that if you can identify something that's happening over a long arc, if you can buy the company at a fair price and just hold on, then that's a pretty good strategy. The key is you don't want to get into something that's overpriced because your downside would be too large. And so that's the kind of the way we look at it. And that's kind of how we keep looking for these new companies with big step change opportunities.
Switching back to page 1, Tesla at the right price, it seems to me, is a large company. It could have that kind of step change potential, not necessarily from cars, but from autonomous driving. And we talked last week about who would perform better, Tesla from $150 a share or Nvidia from $150 a share. Now, Nvidia is considerably under $150 a share, and Tesla's still, $300 or but given the news on Tesla, which is that sales or new registrations in Germany are a fraction of what they were last year, same thing happening in China. The Tesla stock just moved based on their cash flow from their automobile operations. You can make a case for a lot lower stock price. And what Mike just said is interesting. If you find one of these things, you're probably going to be going in at a price that is a significant amount of overvaluation with the attendant risk. So I think it's premature on Tesla. If this were going to turn into an investment to double or triple your money, irrespective of how the macro picture looked or how the capital markets look, I just think you have to get in at a lower price. But since having made that point, and that's a judgment each investor has to make. I mean, there's no one can hold forth with any kind of standing and take, a valuation level where it becomes a good investment. That's what makes investing so interesting. That's just not feasible. But one of the things we can talk about is where the additional value would come from, away from making, very good battery cars. And one is autonomous driving and the other is robots. It seems to me that autonomous driving is much more likely to produce a step change one things I hadn't realized, I was focused on 500,000 or 600,000 Model Ys and Model 3s in our economy, but there are 5 or 6 million Teslas out there in our economy. So presumably they all could be fitted with autonomous driving. Mike and Jason spent a lot of time looking at this, how in a 3-year period, say from this point forward, say into 28, what type of, rather than focus on revenue, what type of cash flow could develop? I mean, what range of cash flow could develop from most Teslas on the road using their system?
I think that's an interesting way to look at it. And there's a lot of regulatory risk built into that question with, will autonomous driving systems be approved? Maybe at the federal level versus at the state. And then if it's state by state, then you got to break each one out. But it should be pretty cash flow positive. I mean, if they've already sold the vehicle and now they're going to monetize that vehicle driving per mile and split that with the owner, the value proposition is huge, right? It's going to bring down the cost of purchasing a Tesla. In I believe in California, Model 3 is still the cheapest car you can buy now. And now that car has the opportunity to generate revenue for you. It'll be interesting to see how much. There's a lot of talk around the economics per mile of operating one of these systems. And I believe Elon himself says they want to push that down to 25 cents per mile. So at that low level, how much revenue is it really generating is a great question to ask with whatever happens with insurance and maintaining the vehicle with strangers riding in it. But it's a really interesting thing to think about. So Uber has about 3 billion rides per year. AAA's data suggests that Americans take 250 billion trips per year, which puts Uber at about 5% of those trips, which it seems very high to me. But at that level, if 5% of rides then go towards a Tesla rather than Uber, because it's a much lower cost system to take a ride in, that's a huge amount of trips that they're going to split.
Yeah, and if they're successful with it, you're talking about more than just taking maybe share from another player, but more expanding the percentage of rides that are taken by a non-owned vehicle. So we think that they will have a step change in cash flow between then and now. But, the downside is if we're utilizing cars a lot more, how many cars are needed on the road? We were talking about this morning. The number of Ubers on the road today are around 440,000 or something like that. It's not that many vehicles at the end of the day. So you need a huge shift in consumer patterns in order to justify more. And maybe they get cheap enough that everybody owns one, like we do with a cell phone. And when you get to a $25,000 vehicle, you could get down to that cell phone bill kind of like size if you factor in the revenue you might generate from partially putting it onto the rideshare network. So it's it's a complicated picture, and it's one of these things where I think it is similar to what was happening with Nvidia back in 2015, 2016, is that it was inevitable that people would be doing more computing on GPUs, not just gaming. I think it's inevitable that people are going to be using self-driving cars. What's difficult is sizing how big that market is and where that value accrues. I think in the case of self-driving, it's fairly safe to say that low cost, in other words, scale economics, are what will drive competition. And that paints a very good picture for a Tesla full self-driving solution. But as Jason said, regulatory is the key risk because regulations may change the way that works. It may prevent a non-LiDAR system from being able to operate for various reasons. So I guess it is still up in the air as to whether it will happen for Tesla. But I think it's inevitable that autonomous driving is going to be the way probably my kids end up getting around most of the time.
Uber's back on page 20, and their run rate of revenue is 40 billion. I mean, is this too simple a way to look at it? Within 3 or 4 years, would autonomous driving, either using people's cars or using, a $25,000 or $30,000 robotaxi, which they make a margin on, but once those robotaxis are out, I mean, could Tesla do 40 billion of revenues from autonomous driving? And if so, would the margin be half? And if we turn back to page 1, and their revenue is 100 billion range, and their free cash flow, their capex was pretty significant last year. Their free cash flow is 2 billion. They do have a strong balance sheet. They have 36 billion of cash and only 6 billion of debt. I mean, can we consider that somewhere, in the next 3, 4, 5 years, their free cash flow, rather than being 2 billion, bulked up by autonomous driving, because they're as large in the market as Uber is, but have a much better margin, that they have 20 billion of free cash flow? Or is that the category of being way, way, way too optimistic? Jason, you're the Tesla bull, so address it directly at you.
I don't think it's too optimistic. I think when they produce a low-cost robotaxi, and it's still a question of, will Tesla operate the fleet themselves, or will they sell these vehicles? If they were to sell them, I think they'll be constrained on how many they can make. Individuals are already operating rental car businesses through platforms like Turo, and if there's no reason they wouldn't operate a self-driving autonomous vehicle taxi business as well. It's going to be extremely disruptive to rental car companies. Maybe Hertz ends up as a fleet operator of robotaxis. Those types of companies or individuals are going to buy as many of these vehicles as they possibly can. It's going to be early data out of Uber and Waymo's partnership is showing that people are willing to pay $10 a ride more to have a Waymo pick them up. And maybe that's just the novelty of it right now, but people like the experience a lot better. So I don't think robotaxis will be more expensive than Ubers, but as soon as they're widely available, I think everyone's going to make that choice to take a robotaxi, especially if they're in an urban environment.
Right. Musk, in his more expansive moments, says that Tesla will eventually pull even with Apple. Apple has about 100 billion of free cash flow. So if you were able to get to 20 billion of free cash flow by 27 or 28, you'd be making real progress.
Right. And we still don't know the model that they're going to, the business model that they're going to charge for robotaxis, but they make an extremely high margin on selling licenses for full self-driving on existing vehicles. So if that's, the bulk of where they're going to generate profits from.
Yeah, there's many ways. I mean, I think with many of these tech businesses, there's many ways to charge, and you have to figure out the right place to extract your profits. It's really nice to be able to do that on something that has zero marginal cost. And when you have the full self-driving software at zero marginal cost, it's really nice to be able to do that and then give away, the platform, if you will, as a way to lock everybody into one solution.
Before we jump to help and to set us up for the next Wednesday, we can't just be talking Tesla and Nvidia every Wednesday. Just a coming attraction on page 4, you have Netflix, Disney, Meta, Spotify. I think you could argue that Netflix, maybe not to the extent of Nvidia, has accomplished a step change. And of course, it's up a lot in value. But I mean, they've gone from break-even cash flow to having 9 billion of free cash flow, and in their latest year, they managed to take their free cash flow from 4.5 or 5 up to 9. And so I think what Mike calls this is network effect. And of course, on page 4, we also have Spotify, once again a company that was kind of break-even free cash flow and now has 1.5 billion of free cash flow. So we've got to jump to healthcare and see if there's any healthcare news. But when we're together next Wednesday, we'll focus in on this page. And then, of course, the question is, Netflix is, has its inventory, but I mean, it, to a very large extent, it's delivery, where Walt Disney, has more content than anyone else. And for the last 12 or 18 months, Jason's been kind of a meta bull, and he's been right as rain. Any commentary from each of you, either of you still leaving 5 minutes to do healthcare news?
Well, I'd say with Netflix, what we learned, and it's just obvious in hindsight, but it wasn't totally clear to me, at least, and maybe shame on me for that. But during COVID, you saw Netflix spending aggressively on content. And you also saw a lot of competition entering the market. So they were logically spending down every ounce of cash flow in order to fend off competition. And in a post-COVID world, those companies that were competing are now being much more fiscally responsible, which basically means they're investing less in their platforms. And that has basically just allowed Netflix to throttle back on their content spending. And that is translated directly into cash flow. As the scale operator or scale player, they have that unique advantage of having tons of content and tons of users. And therefore, when they scale back on spending, it falls right down to the bottom line.
Yeah.
So I'll take Spotify then. Spotify pays a royalty to the artists in the recording studios. So not as good of a model in my opinion, but a lot of Spotify's listens go to, you'd call it like background music, classical music, noises, that kind of thing. And someone created that originally, and they are getting a royalty on it. And what Spotify is starting to do is generate that with AI. So because it's not something you're actively listening to, it's less important that it's high quality music. So that is generating them a higher margin on a good percentage of their listens.
Yeah. And then Meta, how low did Meta get, Jason, after Apple kind of substantially dented their ability to sell tracking data and advertising? I mean, was it a $200 stock or $150 stock? It's painful to think about with the stock almost 700.
Was it under 100?
Oh, it was under 100.
Yeah, it was hitting us over the head, and we kept looking at it, and all the news was as bad as it could get.
We had our model whiteboarded just because we're like, we couldn't understand why it was so cheap, and we still didn't pull the trigger. So, in hindsight.
Even in a fairly large company, I mean, making 6 or 7 times on your money in 2 years is pretty good. So we can't sit and dwell on things we didn't do, but we have to kind of learn from it.
Okay, let's take a quick break for a message from Oakcliff Sailing.
Hi everybody, I am not at Oakcliff today. I'm actually in Daytona Beach, sneaking 2 days in between one stop and the Virginia stop on the tour, which is this Saturday. Ewan, our high school sailor, and Ethan, the training director, are in Pensacola racing and practicing and training at the foiling camp, which has turned out to be super cool. And back at Oakcliff, they're getting closer and closer to launching all the boats. April 5th, we have an art show that we hope that you will come to. And that also brings up the point, if you did not get an email about the art show, if you did not get an email personally from me yesterday, it's time to go to oakcliffsailing.org and sign up for the newsletters. We want to keep you informed. We want to help you in your sailing career and your philanthropy. And I hope that you have the sun come out like we finally did here in Florida. Talk to you soon.
And now back to the show.
So, Jason, before we finish up healthcare news on Vertex or Lantheus or Arrow or anyone else?
So there's a series of healthcare conferences going on, and they've all presented, but nothing really material out of them at a company specific level. I think we brought up on one of the previous calls cuts to Medicaid. From what I've seen, the proposed cut to Medicaid is $880 billion over 10 years. So you can roughly estimate that to 88 billion a year. I pulled some data together that the Academy of Medicine produced looking at 2019 data out of both Medicare and Medicaid. They estimated that 210 billion was spent on unnecessary care, and then further 100 billion was in just completely fraudulent claims. So if you look at those numbers and we can start to use like some modern tools to try to combat fraud and waste, maybe some learnings out of the big banks. I know JP Morgan with their Chase banking system is extremely aggressive with how they implement technology to look for fraudulent charges, fraudulent billing. If you implemented some of those same strategies in the healthcare system and CMS system, it starts to make sense that you could cut that amount out of Medicaid and not degrade services. That's a big if we can combat fraud at that level. But the waste in the system by the government's own measures is there to be eliminated. So I haven't heard, the White House or the DOGE department address that explicitly, but I have to imagine that's, they keep saying fraud and waste. I have to imagine that's the kind of things they're looking at when they're talking about they want to cut this number by this much.
Right. Yeah, let's just in closing, let's switch back to Exhibit A. The revenue for the fiscal year we're in, ending this September 30, is right around 5 trillion. The GNP for that period is right around 30 trillion. So our revenue is probably pretty likely to, keep as a percentage of GNP. And we spent 7 trillion. Some of the spending is completely involuntary because we have 37 trillion of debt, a trillion of interest. That's a 3.5% average rate. I mean, that number is not likely to go down unless we get down to very low interest rates like we had after 08. The numbers Jason's referring to is the Medicare expense, which is about $1.15 trillion, and the Medicaid expense, which is around 600 billion. The Medicaid expense goes out to the states, but between the two of those, that's about 1.8 trillion out of our. If you take your 7 trillion, you take $1 trillion off for interest, that's 6 trillion. So almost half of the spending away from interest goes to healthcare. And so if there's going to be significant progress here, it's got to be in that carry, that particular couple of lines.
I'll add too that the new head of the FDA is Marty Makary, and one of his main interests is cutting out unnecessary care. He's not confirmed yet, but if there really is 200 billion in savings to be had, that's going to be. I can't imagine that wouldn't be one of his primary focuses.
Yeah,
and a plug for Haro. He used to be he resigned from his role, but he was a board member at Haro.
Right. And just for comparison, I mean, our defense spending is $900 billion. We keep telling the Europeans that they need to get to not just 3% of GNP, but 5%. Well, we're barely at 3% ourselves. And to expect, are we wasting money there? Absolutely. But would the waste kind of be reinvested in things where we're behind, coping with hypersonic missiles or drones? I don't see that 900 billion going down. All other, which is everything the government does, other than Social Security, Medicare, Medicaid, interest, and defense, is $1.3 trillion. Before COVID, that was 900 billion. I mean, clearly 100 or 150 billion can come out of that. But to make a significant dent is going to require healthcare. And our Treasury Secretary, has Well, he has 3 threes, but the first 2 threes are 3% real growth, which would help enormously on the revenues. And then the deficit being 3% of our GNP. Well, if our GNP is 30 trillion, 3% of that's about $1 trillion. So, it'd be a heroic effort to save even 500 billion, but that's what is necessary. And even the people that don't support Trump, have to acknowledge that this effort has to be made. I mean, we can't just continue to run our debt up. And probably the best we can hope for is get our debt where it doesn't exceed GNP. But right now, I mean, GNP is $30 trillion and our debt's 37. So, I mean, we have a lot of work to do there. And with that kind of sober message, we'll be here a week from now, next Wednesday, and focused on step change. Just a concluding message where we have these macro problems and the capital markets will be volatile, especially as we've seen. I mean, the stock market's back about where it was on election day. So much for the Trump dividend. If we can find and invest in these step change businesses like Nvidia, like Tesla, possibly, like Netflix is able to do, and if we can find these things, identify them, look at them 6 ways to Sunday, that clearly is the best thing to do for investing going forward. But everyone be well and stay healthy. And as I say, we'll be back here next Wednesday. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.